friends, the calendar year 2018 to date was marked by high market volatility. While the Nifty index has remained resilient amidst negative macro news flows, the mid and small cap indices have faced the brunt, falling 15 to 25% from the recent peak. Within the Nifty index also, except for IT and FMCG sectors, all other sectoral indices have corrected by 10% or more. The top of the mind concerns of investors include higher crude oil prices, rising bond yields, INR depreciation, SEBI reclassification of some of the schemes, and geopolitical issues like trade war tension. While the macro headwinds are there, we reckon that if the underlying demand growth is strong, then the companies will be able to pass on increased cost and report increased profitability over the next few years. Historically, Nifty index and Indian currency have performed well in periods of rising interest rates if the growth cycle is accelerating. Also, the markets don't have a strong correlation with crude oil prices over longer time frames, which means that equity markets have done well over longer cycles despite higher crude prices. On the positive side, the high frequency data points suggest that growth is good in most cases, particularly in two-wheelers, commercial vehicles, tractors, direct tax collections, and capital goods. Also, the management commentaries of the recently concluded quarter are positive as corporates are seeing an uptick in the consumer demand and improvement in investment climate in the country. The Nifty earnings growth, which is coming off a low base of depressed earnings over the last few years, is expected to accelerate going forward, providing an opportunity to invest in select stocks that benefit disproportionately with improving fundamentals, considering improvement in micro data. Also, the recent correction in small and mid-cap stocks have helped on valuation front, with many of the fundamentally strong companies' stocks getting attractively priced. We believe that this is an opportune time to invest in companies that benefit from micro turnaround, change in business cycle, management change, deleveraging or demerger, which may give higher upside potential with catalysts expected to play out over the next 2 to 3 years. The India Special Opportunities portfolio aims to invest around 65 to 70% of the portfolio in companies that will benefit from these catalysts. The balanced 30 to 35% of the portfolio will be invested in secular growth companies and those that have potential to migrate from mid-caps to large caps. We believe that investing is a combination of science as well as art, where we use quantitative as well as qualitative filters to screen companies with high return on equity, low leverage, consistent management track record. Among these, companies which are on the cusp of macro or micro turnaround or in the process of demerger or deleveraging, or those which have undergone a reshuffle in the top deck will be identified. Further from this list, companies which have got high growth potential over the next 3 to 4 years will be included, leading to around 20 high quality companies for the portfolio. Some of the quantitative filters that we would focus on include companies with strong balance sheet, good capital allocation track record, high return on capital over longer time frames. The qualitative factors include companies with high corporate governance, established business model, high market share, and skilled management. The micro catalysts that are expected to drive wealth creation include change in management or strategy, improvement in margins, improving market share, launch of new products or technology, and high return on incremental capital. Let's look at a couple of past examples. In Britannia Industries, Mr. Varun Berry joined as an MD in April of 2014 and overhauled the key management team. He focused on premiumization of portfolio, reducing the manufacturing and distribution cost by lowering channel margins and outsourcing production. Also, the company focused on launching new products in adjacent categories like dairy and bakery, which grew the top line and improved the margins from 7% in 2013 to 15% in 2018. This led to the share price appreciation by 10 times over the last 5 years versus just about 2 times appreciation for the FMCG index. TVS Motors is another example where new products have driven growth in the recent past. It is one of the few listed companies in India to play the scooterization trend, with Jupiter scooter market share going up from 2% to 12% in the last 4 years. Also, the premium motorcycle Apache has seen market share gains from 8% to 13% over the same period. This has led to the stock appreciating from Rs 30 in 2013 to around Rs 550, which is almost 15 times versus 2.5 times for the automobile sector. The macro catalysts that could benefit companies include improvement in the regulatory environment, demand revival-led growth, sector consolidation, supply-side curbs, and rupee depreciation. Titan is an apt example which benefited due to improvement in regulatory environment, in this case, the implementation of GST. Its earnings grew by 43% in FY18, which was flat between 2014 and 2017. This also led to almost doubling of its share price over the last 1 year. Curbs on supply side too can benefit existing players. For example, Chinese clampdown on polluting industries benefited existing Indian players in metals and specialty chemical space. Graphite Industries was one of the key beneficiaries of this trend. While some of the catalysts may not play out as expected, we believe that diligent focus on the right parameters with right investment framework could lead to decent wealth creation over the next 3 to 5 years. Thank you.